To understand investing, it's a good idea to understand the investing process, how investing works and what you can do. The first thing to understand about investing is why you'll see and hear the following disclaimer. The value of investments and the income from them can go down as well as up, and investors may not get back the amount invested. Anyone who provides investment advice has to make it clear that there is an element of risk in any investment. If there was such a thing as a sure thing, everybody would be investing in it. Your investment horizon is the timescale you want to see a return on what you invest. A typical investment timescale is between 5 to 10 years. This provides a short enough period of time that you can do more than one thing with your money, but a decent amount of time to grow what you invest. This contrasts with a pension timescale of maybe 20 to 40 years. The greater timescale allows an income for retirement to be built over your working life. Typically, we see that clients want one of two things when investing, either to grow their capital or to generate an additional regular income. It's certainly something worth talking about with an independent financial advisor. Perhaps there is a specific goal you want to achieve with the investment, such as a new house, a holiday, or a luxury car. These goals can help shortlist the best options for investing your money. Everyone's appetite for risk and their capacity for financial loss is different. This is an important thing to think about, as the greater the risk, the greater the reward, but the greater the danger of loss to your money. At Burton & Fisher, we use some very clever software to generate a risk profile through 20 simple questions. It helps our firm to measure how much risk you want to take when investing and whether your circumstances can comfortably take that risk. Your risk profile will match with a pre-designed investment portfolio that aims to provide the return you require with the level of risk that you are comfortable with. Low risk can mean a potentially lower return, whereas a higher risk can mean a potentially higher return, but a greater potential for capital loss. So what will your investment portfolio be made up of? At Burton & Fisher, we break down investing into 4 main asset classes: property, cash, bonds, and equities. Cash is the safest investment you can make and the easiest to get a hold of quickly. The downside is it is often at a low interest rate, so while safe, you may not make a great return on your investment. It will also be difficult to outperform the effects of inflation. Property provides a regular rental income or yield and the potential for the value of the property to go up. Investing in property means locking in the value invested, as there is no guarantee that you will be able to sell when you want to. In order to reduce risk, it is safer to invest across a few properties rather than just one. Bonds can be basically defined as loans to companies and governments. Your money is lent to these entities and they utilise these funds within their business. Bond returns are a little better than cash, but the risk is higher. Confusingly, the return on bonds can be dependent on expectations for interest rates. And bonds can generate higher or lower returns than cash, so sometimes cash can be a better option than bonds. Equities are essentially the stocks and shares of a company. You provide the money and agree to share in the risk of the business, in that you could lose your money if the business collapses. The expected return on equity can be anything from making a huge gain to losing everything. Many investment portfolios are never reviewed, and we feel that it is essential, especially as the financial environment changes constantly. This can have a huge impact on the holdings within a portfolio. Keeping track of all these changes and the expertise to react positively is where an independent financial advisor can really help. We manage portfolios on an ongoing basis at Burton & Fisher, and our aim is to reduce complexity without reducing control by understanding what your circumstances and goals are. We invest in our relationship with you, and our team is here to support your decisions, ensuring returns are maximised and goals are achieved.